So as you know, I'm a CPA, and we've hired two other CPAs here at NexMetro Communities. All of us have worked in public accounting on the tax side for various firms, and we've got over 20 years of knowledge collectively underneath the NexMetro Communities roof. What that does for an investor is we understand the inner workings of public accounting and the tax side and what it takes to get Schedule K-1s out to our investors in a timely fashion. The other aspect of it is we are able to work directly with the public accounting firms and know exactly what it is they're asking for, which will also speed up the process. And as opposed to having external CPAs provide counsel to internal accounting personnel that don't quite know the tax side, we're actually able to leverage both of our knowledge sets and bring in tax credit studies, cost segregation studies, really make sure that we're getting all of the tax benefits out of these projects as possible, and that will ultimately increase returns to our investors on a post-tax basis. The other item I think that's important to note just on NexMetro Communities investment vehicles is it's a very tax efficient investment product. So early, about 2 years in the investor life cycle, we should be kicking off ordinary losses to our investors that can be taken as a deduction against other passive income. So we get large ordinary losses up front, and then 2 years after those ordinary losses kind of kick in, that's when large capital gains are being treated or being generated for our investors. And so if you think about it, we're front loading ordinary losses and then backloading capital gains treatment, which ultimately is a good result for our investors, and all the while receiving tax-free distributions throughout that time. So.